as I said, we're going to jump right into how to prepare for budget season. And I'm joined today by Laura Gelman with Rogers, Woodhill, Starman, and Gustafson, PA. And I am Shauna Fleischbein with Castle Group. So Laura, I'll go ahead and let you kind of introduce yourself and your firm.
Okay. Good morning, everybody. As Shauna said, I am a partner with Rogers, Woodhill, Starman, and Gustafson. I know it's a lot of words, but we are actually the oldest professional association in Collier County. We have offices in both Marco Island and Naples, Florida, and we serve clients all over the west coast of Florida for condominiums. So I'm glad to be here with you. I've been doing this personally for almost 25 years, so I hope that my knowledge is helpful and can maybe help make this process a little bit easier for you.
Yeah, fantastic. Well, we appreciate you being with us today. And as many of you know, I know there's a lot of people on here, who join our webinars regularly, but we're Castle Group. We are an association property management company. Generally, we specialize in on-site management full-time, so dedicated managers, 40 hours a week to your association. So that ranges anywhere from large-scale HOAs to mid-rise condominium complexes, as well as towers. So we'll kind of be here to walk you through from the operations side of the budget process as well. So here is our course outline, kind of an overview of what we are going to cover today, and really what Laura is going to cover from her expertise. So, your purpose, how to build the budget, understanding all of your community expenses, which is the big one, your sources of revenue, your reserves, another popular topic, transparency, putting it all together, and then we'll kind of close up with any questions we may not have gotten to throughout the presentation. So Laura, I'm going to go ahead and hand it over to you. I'm going to go ahead and put everything up here so you can run through it.
Okay. I just also want to say, I know that there were some questions that were sent in yesterday to Castle, and I'm going to try to cover those as we go through the presentation. But if you have sent one in and I have not covered that, please send it in again to Sean. I don't want to miss anything. So I just want to make sure that we get you covered. The most important thing is, why do you need a budget? Why do you need a budget? A condominium is like any other business. You can't just run it fly by night. You're using somebody else's money. And most important for the board to remember is you have a fiduciary responsibility. I know it's a lot of work to serve on a board, and I know you all make a lot of money doing it. So, I mean, the pay is great. But we need to make sure that it's done correctly. It's not always a very popular thing to do, especially if you have an association that previously has not really budgeted well, or even has not budgeted, because it usually means that there's going to be an increase in costs. So it's still important to do it. You need to make sure that you have money available when those projects come due, whether it's in the operating fund or in the reserve fund. You have to plan for the unexpected. We live, most of this, I'm assuming that most people on this webinar are in South Florida, and we have hurricanes. We have things, everybody else, this pandemic was new to them, but we have emergencies like that every few years that can drastically change what's going on. So you need to build a budget. You need to build a roadmap of how you're going to get from point A to point B, and do so in a manner that is using your owner's money in a responsible manner. So if you want to go to the next slide. Okay. Normally, we recommend that the budget is ready for your finance committee by the end of August. And I know that Castle Group has their manager starting to build the budget shell in June, which is a really good idea. The process of the budget really starts with the manager. And if you have a finance committee, we're going to go into a little bit more about this, but I know one of the questions was, what does the finance committee do? They really work with the manager to make sure that everything is included and where can they look for savings and where can they look for new projects. It's a great resource for your manager to be able to have other people to bounce ideas off of. Maybe they know of another association that has used certain contractors. It's just really kind of an interconnection between the actual end of the budget with the board and the manager. You cannot expect a manager alone to do a budget. You use historical data to start, but it's not just a matter of running last year's expenses, adding 3%, and then handing that budget to your board. And I know that's what happens a lot of times with associations. And I know Castle is very good about working through this process, but you really need to make sure that that's being done. Otherwise, you're going to get caught off guard. So, main thing, start early. Make sure that your finance board or whoever's going to be reviewing the budget has it by the end of August. We generally recommend that the budget should be ready for adoption between the last 2 weeks of October and the first 2 weeks of November. And Shauna, does that kind of correspond with your dates?
Yeah, so Castle, we definitely, when it comes to our meetings and our budget adoption especially, we kind of play it on the conservative side, because the last thing we want are for coupons to go out late. We want those coupons to go out before the end of the year, so that they're there and they can be paid on time. So generally speaking, we try to have as many of our associations have their budget adoption meeting by the end of October, if at all possible. Of course, there's always some, outliers and exceptions, and that's fine. But if we can have those budget adoption meetings done by the end of October, then we can ensure that those coupons are going to go out in time before, well before the end of the year. So that is our goal. And I know for us too, you mentioned, benchmarking and things of that nature. So one of Castle's policies with our managers is, number one, we have our budget success checklists that we supply to all of our managers every year at the beginning of budget season, and we get all of our managers together by region. So the regional VP or president will generally get their whole team together and run through the process. Just do a refresher. Hey, some of these managers have been with us for 10 years, but we still like to do a refresher every year. And our managers also kind of chat with one another. Hey, what are you paying for your landscape? What are you paying for your irrigation repairs? What are you paying for your pool service? Just like you said, to kind of benchmark and see, because sometimes they find they're using the same vendor and paying completely different prices, even though they're in similar communities. So it's important to do those things and to share best practices and to chat with other communities. If you're a self-managed community and you don't have a property manager, don't be afraid to reach out to your neighboring communities if you have relationships there.
Exactly. And that's where we find that, especially for self-managed, you can rely on that finance committee to assist with that. I just think it's a really good idea to also include your management company. And I'm not saying this because Castle is on this, that I'm doing this with Castle. Honestly, they have a volume relationship with a lot of vendors, and that's an asset to the association. And you want to use that when you're getting quotes or you're trying to find out. I know people had mentioned that they're having trouble getting quotes for next year. And I think that relationship is very important to use at that time. The other thing is that it's a business. If you can't get your vendors to give you a quote for what you want to do next year for your budgeting process, talk to their competitors. Tell them that you need something. The other item that I have seen more recently is actually for vendors to say, okay, we can't give you an exact quote. Building costs and everything are going up so fast, but we'll give you a quote with a not to exceed. Like, it won't go over 5%. So at least if you are choosing to still deal with that vendor, there's a variety of reasons that you choose a specific vendor. And that way, at least in your budget, okay, well, we're going to build in this 5%. If we come out ahead, great. I've never heard an association complain that something has come in under budget. So
yeah, and like you said, if your vendors are not willing to chat with you, they don't have to give you specific numbers. They don't have to give you quotes, but they should be able to give you an idea of any increases expected. And if they're not going to give you that, you may want to consider looking at other vendors, because most vendors are going to be willing to do that if they want you to be able to budget properly for their services. So yeah, and I know, so we had a question come in from Gerald. Why wouldn't the PM know of what is happening in other developments, especially in regard to different vendors that are successful, instead of the finance committee? So Gerald, your PM actually should be the one who's bringing that information to the finance committee. If you have a property manager, they are the ones that should be getting that information, talking to other managers, talking to vendors, and then meeting with the finance committee to share that information. Granted, there might be people on the committee who are work for specific, they might be insurance or something of that nature, that they may have their own knowledge there to share as well. But you are correct, it should be the PM who is bringing that information to the committee. And speaking of committees, we had a question come in too about whether those planning meetings should be noticed. So that is the attorneys always like to say, it depends. So it depends. Generally, if it's a chartered committee, usually you need to notice those meetings. If it is not chartered, there's some, you have to read your documents. You should just chat with your association attorney to confirm, because it's one of those situations that, depending on how it's set up and all of that, you may get a different question or a different answer depending on what attorney you talk to, depending on how they translate the statutes. So just check with your attorney if in question with that, to make sure that you're dotting your I's and crossing your T's.
And just following up on that, I don't know how many people that, if everybody on here is working with a property management company, but I work also with a lot of self-managed people. And I recommend, yes, your property manager is the person that is responsible and should know what's going on, but don't be afraid. If you've got an association that does have a good committee, work together. It really does. It's a benefit to both of you if you can do that. The other thing with budgeting, everybody likes to say, okay, we're going to have next year's assessments are going to be X, Y, Z. Can't do a budget that way. You need to start with your expenses, and you need to look at your expenses realistically. Everybody wants to think that the painting is not going to cost as much, and they think that we had a lot of repairs in one area, so we're going to reduce our maintenance and repairs. It doesn't happen. Buildings age just like a regular house, so you can't start trying to cut your budget to lower fees. I've heard for years, well, I play golf with this person. It doesn't matter. It's your fiduciary responsibility to maintain that property. So the first thing to do, and again, if you have a management company, this is great, because they are going to be able to give you a good list of expenses. You have your expenses in your income statement from the prior year, and then they should know what projects and things need to be done. So just remember to always begin with expenses. I don't know if you can switch the slide here. I'm not sure if the next one. On the expense side, contracts are pretty much easy because somebody is going to be negotiating them. Your property manager should be able to tell you, we're going to have a 3% in cable. We're going to have, so much in. We're hearing that, FP&L or Lee County Electric, they're going to have a 3% increase. Down on City of Marco Island always has water increases. So those are the easy ones. What you really have to look at is, what are your actual expenses for your landscaping? When you do your landscaping, you have to build in a contingency. Now, I know we've talked about contingency line items, and I would, as an auditor, if you have a contract or if you have landscaping costs, you need to build a little bit of contingency into these line items rather than just have one great big catch-all contingency account. For one thing, it will assist you in doing your budget the following year. You need to know what those costs are. If you have a contingency line item and at the end of the year you have put in $10,000 of cost for landscaping and a water leak for 5,000 and an elevator repair you didn't plan on for 3,000, you're not going to be able to use that to budget. So landscaping is always going to be contingent upon what happens during the year. Do we have a drought? Do we have a hurricane? Now, where I like to see a contingency item, and the best practices for me are if you want to set up a contingency item for specific things. On Marco Island, we have a problem with our pipes. A lot of associations are finding that they're getting pinhole leaks. So this is an ongoing problem. You don't know what it's going to cost you. So a lot of them will say, okay, we're going to put in a contingency for so much in these repairs so we can track them. That to me is a contingency item. It's something that you really don't know about. You may want to have a contingency for, we're going to put in a little bit extra if we have a bad storm. Not enough that we're going to be in the reserves and we're talking about a major hurricane, but we could have a tropical storm that takes out, all of our front landscaping. So if you want to have a contingency, but in that contingency, you really need to have a good idea of what it is for. It should not just be a blatant catch-all. Okay, I'm going to do my budget and then I'm going to put $50,000 down here just because I don't know what it should be for. And that is what we see. A lot of questions about what is the best way to budget for insurance. The best thing you can do, have your property manager talk to other people. What I have found is that it takes about a year for the increases to actually go into effect after a hurricane. They usually stay up for about 3 years. You have to be willing to look at other companies. Again, in Southwest Florida, we are limited, especially if you're on the beach, because there are only certain companies that will even write those policies. So we really are at their mercy. And when you start hearing people say that it's going to be a 30% increase, don't say, okay, well, we're going to try 20, because you're going to wind up holding the bag. You're better off budgeting for it. If you have an overage, take that overage from that line and say, okay, we're going to reduce the insurance line next year because we overestimated. But that's one of the biggest things, because nobody wants to believe that they're really going to get a 30% increase in insurance, and it's going to happen.
Yeah, and I can tell you that goes back to what we're saying, like we get our manager. So if you have a management company, your management company is working with a lot of different agencies, insurance reps. And so we can hear from all of them and get the idea. And generally, they're all pretty in line. So you should be able to get, listen, nobody has a crystal ball, but they have a general idea. And if you're hearing that same consistent amount coming from all of them, then you're probably, that's probably a good estimate.
Exactly. Common expenses have to be, according to the DBPR, they are common expenses to maintain the property. Can't be for a holiday party, can't be for something that is only for some people in the association. Some of you have limited common elements, and you can't just do something for that group of people. That should not be part of your budget. That should be handled outside. I do, again, recommend from an audit standpoint that you need to be very careful when you're taking money outside of the association to keep it outside and let owners handle it. If there is any bank account that is under the association's name and ID number, it is subject to audit. So, and again, this is more for your self-managed. Don't let somebody come in and say, oh, well, let's just set up this account over here for social events and we'll just use the ID. That cannot be done. Then all of those transactions need to become part of your audit.
Yeah, and a couple of items to add from this list that from an operations, standpoint, from just a good practice standpoint. So when it comes to your contract, so Castle actually uses a contract renewal schedule that every manager creates for their community that lists, it's pretty much an Excel spreadsheet that lists every single contract the association has, who their contact person is, what are the terms of the contract, what is the termination clause, what is the renewal schedule, because that becomes, if there's an annual increase, already built into the contract. So it's a one-stop kind of cheat sheet for you to refer to when you're doing your budget, instead of trying to go pull all the contracts, just have it all in one place where you can refer back to it, very easily. And then another thing to keep in mind is, generally a budget shell is built in like an Excel spreadsheet. So all the way to the right, create a line item or excuse me, a column for your notes for why there was an increase or decrease. Because then when you're referring back to those budgets, the following year or whatnot, you remember, you see, you have nice notes there telling you why you increased or decreased that line item. It also makes it nice when you get to the end and you have to start explaining to your membership why there were budget increases and whatnot. It's easy reference for you to go back to instead of trying to be like, oh yeah, why did we do that, or what was the amount? So just a best practice to create a little note column for those things that you change in your budget. All right.
And the fact that your manager keeps that contract list is wonderful. We do not see that in a lot of associations, and it does make your budgeting time more difficult. And even just during, again, I'm trying to give a little bit from your financial statement preparation. It's really nice to have those on hand. So that's great to know.
Yeah, absolutely. All right, understanding all community expenses.
Okay. Every property is unique. Somebody had asked me about, is there a place to get a list of expenses, kind of like a benchmark? And I know that Castle has some just because they are in the business of doing this, and they can provide some of that to you. As far as a national scale, I have never seen one done. And I don't know really how beneficial it would be because, as I said, we're in a unique situation here in Southwest Florida. I really think that the place you need to go for that is your management company. I think that they're going to be your best resources for that.
Yeah, okay, it really depends on where you are, your location, and as well as your community. How old is your community? Just depending on what it is. So yeah, there really is no catch-all there. You're right.
Exactly. So when we talk about knowing your property and its needs, as Shauna just said, this is case in point. We have associations where one group of buildings was built, maybe the last group of buildings was built 10 years later, okay? Their expenses are not going to be the same, okay? Now, I'm not talking about amenities and things like that. I'm talking about the age of the building. Anybody that is in Southwest Florida knows concrete restoration, when you first turn over a property, is nothing to think about. 10 years after being on the beach, it's a major concern. And it can be planned for as it goes along. So you need to know where in that age you're at. You have to look at fire alarms. You have to look at elevators. You have to look at your general maintenance. Just like at home, if you have a laundry provision, laundry rooms in your properties that are used by the public, they are going to have more wear and tear than one in your house. I can guarantee it. So you really need to kind of go through your property and do an inventory. And I think that this is basically, Shauna, correct me here, when you're doing the shell for the budget, this is really what the managers are doing. They're going through and looking at the expenses, looking at what is on that specific property and addressing those concerns. Correct?
Yeah, we're looking at current year to date, where we're at in our budget to see, like, are we on track, or are we over budget on certain line items, or are we way under budget on certain line items? We don't anticipate, any big major expenses that are going to cause us to, be, to continue not to be under budget, as well as, like we talked about before, any anticipated increases in the industry, whether it's insurance or, anything of that nature. Yeah, exactly. We'll be putting all that together, putting, all those estimates and guesstimates together to then pass along to the finance committee or the board to then chat through and discuss.
Right. All those points. And again, that's where the board and the finance committee, they often bring up things that may not be on that list of expenses that we've done in this year or last year, but they will definitely bring up items such as, well, did you think about we need to do something around that pool area? Now, it may not be scheduled for that year, but those are your more one-time expenses. Okay, they all want to have a pretty patio out back, or they want to put new landscaping, or they want new pool furniture. So those are the things that are important, that everybody is on the same page, so that those things can be scheduled out. Now, they still can be scheduled in your operating budget. Okay. Your operating budget can include one-time expenses. Okay. Everybody thinks a one-time expense goes to the reserves, but it doesn't necessarily do that. And if it's really something that's just going to be one time and is not a large amount of money, go ahead and build it into your operating budget and don't tie it up in your reserves. Recurring expenses, as Shauna said, that's your property management company. They know what contracts are coming up, what they're going to be. Capital improvements. Capital improvements, we're going to talk about reserves in a little bit, but capital improvements are going to primarily be paid from your reserves unless it's a first year. If you want to add something to your reserves, say you never thought about concrete restoration, and now you know you're going to have it, you have to allow for part of that to be paid out of your operating budget. You can't just add one item to the reserves and start paying it out of there. And concrete restoration is a bad example because that's actually a large ongoing project. But say you never reserved for pool furniture and you want to start reserving for it. The initial cost would come out of your operating, and then you would add it to your reserves. And preventative maintenance. You hear about deferred maintenance in your reserve fund and preventative maintenance. Deferred maintenance in your reserve fund is actually for items such as painting. They are not capital in nature, but they need to be done, and they are maintenance. It's just a difference that is basically in the tax code. Painting, even though we put it in the reserves, is not a capital expenditure. Okay, preventative maintenance in the operating budget is going to be the things you need to keep things running well. You need to make sure that your pool pumps are clean, that that the valves are done, that the elevators, that they have the oil and various parts. That's more operations. I just know that, it's just like being in a home. You have to make sure that you keep everything working well. So I think you can probably go into probably more of the specifics of your preventive maintenance, Shauna.
Yeah, so you really want to try to have a preventative maintenance plan. Know what your preventative maintenance entails for your building or for your property. So one of our best practices is to have some type of like capital asset book or binder or some type of schedule, depending on how many assets that you have, that has, what is the warranty, on certain pieces of equipment, what do you have to do to keep up with that warranty? What is the preventive maintenance? Do you have to have, lines flushed out, or do you have to have, like you said, pipes cleaned, oil, whatever it might be, depending on what we're talking about, you want to keep up with those things, because the reality is, if you don't, everything's going to fail much quicker than it should, and then it's going to cost you more in the end. So make sure that you're investing in your preventative maintenance, because you're going to get a much longer life out of your equipment and your assets there. So it's really important, and just track it. You want to documenting things is the most important thing, and document it in like kind of a one place. You want to have one place where you're keeping all of your preventative maintenance for everything, and all, because you want a one-stop shop. You want to make it easy for yourself, just like we said with the contract renewal schedule.
Okay. One of the questions we had was when you have a new amenities, okay? And I just want to go over this because you mentioned warranties. Review the warranties and discuss the maintenance when you're opening new areas, whether you're purchasing new equipment or you're building a new area or you're adding amenities. Those contractors and those warranties are the place to start. And the other thing that we don't want to do with any of those is we don't want to overestimate revenue. And we'll talk about that in a minute. As far as staffing goes, you may decide that you want to increase staffing. You may need more people, more maintenance. And that's really something that those costs you need to discuss with your property management and your board to see if there's anything that you need.
Yeah, as well as your pay increases. If you're planning any kind of bonuses or pay increases in the coming year, those are things that that if you have a management company, your manager should be chatting with you about. You don't have to say, we're going to give Sally Sue a 3% increase this year, because maybe you don't know if you're going to give her a 3% increase, because it's going to depend on her performance. But you want to budget a certain amount in there at least for your increases. That doesn't mean you have to give each person a specific amount and it's set in stone. But for us, I know we have generally we have a separate tab in our budget, a shell that is, it's not what anybody's going to see, but it's for as you're planning, you have a separate tab that shows just your staffing, because in your budget, you don't want to actually say, this is Sally Sue's pay rate, and this is, Jim's pay rate, and this is John's pay rate. You want to keep very vague on the budget line item. You will have a payroll line item that encompasses everybody, but it'll tie to a sheet that actually does spell it all out, by person, by increase and all of that. But that's going to be kept just for the eyes of management and the board and or committee, not for the entire membership to see. So yeah, that's where those come in. And also just going back to the question that you had touched on that came in about new amenities. I know somebody had mentioned they have a new amenity center coming online with pool and food and beverage and all of that. So if you have a management company, they should be able to benchmark those costs for you. They should be able to look at like communities that they have and tell you this is the average that we're seeing for these type of expenses. That shouldn't be an issue at all. And if for some reason you're self-managed or not your management company is telling you that they can't do that, which I can't imagine they would, unless they just don't have the other communities to benchmark that are like yours. But reach out to boards, see if you can network and find some contacts at some boards and at communities like yours.
Exactly. Okay.
All right. So, and some of this you may have already gone though. So if it's anything very touched on.
I think I think we need to move along, because I know that there's going to be questions with the reserve, but I just want to go back to one thing with the revenue. I have never seen an association yet. Guest suites always overestimate your laundry income. You need to actually, when we were talking about adding a little bit of a contingency to your maintenance line items for expenses, I always tell people, whatever you think it's going to be, drop it at least 10%, because you do not want to be over budgeting. Over budgeting your revenue will be one of the easiest way to come to a shortfall at the end of the year. You have to be conservative in this, because you don't want to get caught having to do a special assessment.
Yeah.
Now,
go ahead. I'm so sorry.
No, go ahead.
Were you getting ready to move on to this slide?
Yeah.
Okay, so there's a couple of questions that came in before we get too far along that I'll touch on really quick. So going back to your common expenses, I know that was a few slides back, but somebody had mentioned, they have a restaurant on site that runs events for members a few times a year, and these events always lose money. And they want to know, can the HOA treat their losses as common expense that all owners have to absorb?
No, because those expenses are not actually common expenses. They're entertainment. You're talking about having a social event there that loses money. Is that the question?
Yeah, let me go back to it. So they're talking about like a Mother's Day brunch, and that, not everyone can attend these. So they end up losing money because they're expecting to have a certain amount of attendance, and then they don't. So they don't get that revenue coming in.
The DBPR does not consider that to be a common expense. That's the best answer I can give you. I know associations do it. I know the losses get put through, but the DBPR does not consider any type of social event to be a common expense.
Okay. And then one other thing, and there was a question here with reserve study, Jerry, we're going to get to reserves in just a few moments. I'm going to hold on your question until then, but James, any suggestions or advice for community turnover? Preparation suggestions for first budget with new member board. Do you want to touch on that, Laura, or do you want me to touch on that? Or
yeah, well, don't follow your developers, because your developers are drastically under budget and probably not fun for reserves. Go ahead. I'll let you use your best practice, because Castle has some for that with their. Go ahead.
Yeah, We do work with a lot of communities that are either in developer control, will be going through turnover, or have just gone through turnover. And I don't want to pick on our developer friends, but I'm sure they, everybody knows, it's no secret that, a lot, of course, developer, they want to keep costs down as much as possible because they want to sell homes and they don't want to have huge assessments, annual or monthly or however often they do them. So of course they want to be very conservative, with their budgets and whatnot. So, yeah, you definitely want to, again, you want to benchmark with like communities. Find your management company, or if you don't have a new management company, yeah, I know sometimes there's weird transition where maybe you don't want to keep the management company you have, or and whatever it might be. We hope that our communities always want to keep Castle on board, but if you're going through developer turnover, benchmark with other communities like yours. Try to make some contacts with board members or committee members at communities like yours. That said, if you have a good relationship with your developer, see if they'll share with you, where some of their past budgeting was, and you can see the differences, because there's always deficit funding involved and all of that you really have to take into consideration. But again, not picking on our developer friends because we love them, but generally you're always going to have an increase. There are things that you are going to have to budget more for. So use your management company if possible. If you're considering making a change in management, chat with some other management companies, see what kind of guidance they will give you if you're going to plan on making a change, as long as you're not changing from Castle. Just kidding. Go ahead.
Don't always think too that a lot of people think they have to change or they should change because of the relationship with the developer and the management company. And that's really not true. Maybe in the way they have done things, yes, the developer is still the boss. But as far as the budgeting and things like that, the current management company may have the best idea of, okay, they kept these areas low because they could. The other thing I just want to mention, it doesn't happen very often, but if you are really unhappy, the developer has a turnover audit that is for the developer. It's done by the developer. But if you are not happy with the deficit and the funding that they are coming up with, you can always come to another accountant and have them look at just a specific thing, not to redo the entire audit. You don't want to do that, but have them review those calculations. And sometimes it's a matter of just peace of mind that they have been done. And sometimes there's some things that then you can negotiate on.
Absolutely. Okay. Well, let's jump. Oh, and somebody did ask, and I don't know if this is something you're familiar with, Laura. We'd have to research and find specifically. But the person who had asked about the event losses, they wanted to know if there was a specific documentation or a specific area in statute, or where they can refer back to where social event losses are not considered common expenses.
If you send me that, or I can send it to you, Shauna, afterwards. I can't quote the statute offhand, but I can get the information for them. Be more than glad to.
Patty, at the end of this, you'll have Laura's contact information, and we'll also send some emails out after the presentation that with Laura's information. So just reach out to Laura and she can get that for you. All right, okay. Let's get moving on here to our.
No, we're going to run short of time. When you look at revenue for your year-end reporting, these numbers, 150,000 to 299 compilation to 499 is a review and then an audit. What comes up here is you may have a budget that keeps you into your budget's always under 499. So you're going to have a review. Okay. The problem is then you get an insurance settlement and it pushes you above the $500,000. You are required to have an audit unless you vote before the end of the year. So that's an area that you need to be really careful of. If you're close to that, review mark and you have something that could push you over, the board may want to consider just going ahead and doing a vote of the owners to step down to a review for that year, just in case it comes up. If you don't want to have to all of a sudden be surprised, because if you have something that pushes you over and you only do a review and somebody in your association complains to the DBPR, they will require you to do an audit at that time. So it's a little bit of preventative. And it takes into account reserves and all income. Okay, so if you have a lot of ancillary operations, make sure that you're including all of that when you're calculating what level of support. Only the owners can vote to do a step down. It is not a board vote. Okay. Proper use of a reserve study. Okay. I'm a very big proponent of reserve studies. I understand that there are a lot of associations and a lot of management companies that feel like they know the properties better. The biggest concern of mine as an auditor is the fiduciary responsibility. Unfortunately, we live in a very litigious society. So people always want to hold you to that. The reserves are an estimate, but I guarantee you that if your assessments go way up or you have major special assessments, people are going to say that you did not reserve properly. So there's two types of study you can do under the Florida law. Straight line, or better known as component method. You list all of the items that you're going to be reserving for. State of Florida, you have to reserve for paint, paving, and roof, and anything over $10,000. People have a tendency to forget that anything over $10,000 and say the state only requires me to do these three. That is not correct. Okay, the other is a pooled method. A pooled method is a calculation, and it will take your beginning balance, and every year you will budget out your expenses and what your income will be, and you can never take that pool below zero. One thing that's coming up in the legislature and has been on the conversation at the DBPR for several years is whether they want that to be level funding or whether it's just a cannot drop below zero. At this point, it is not specified. So as long as the balance does not drop below zero, but just keep an eye out. I'm sure your management company will be well advised if this change does go through. I don't know whether it'll be in this legislative section or not. As I said, they've been talking about it for years. I have not seen it pass yet. The pooled method will generally give you a lower expense. Pooled method, you have to be careful that you have very good people running your board, and you need to be very specific. So capital expenditure, that's if you're going to replace an asset. You're going to replace your air conditioners. You're going to replace your elevators. Or you're going to do a major repair that is going to extend its life. Deferred maintenance is, as I said before, more like resurfacing your pool. That's a maintenance item. You're not replacing the pool. The other one is painting. So the reserves, you can only use reserve funds for reserve items. Again, this comes back to your study. You need to be specific in what your reserves are for. And they are restricted for that. You can't, if you're in a component method, you can't use the roof reserves for the pool reserves. If you're in a pooled method, you can. Thereby, if your roof, it's an estimate. Maybe your roof was supposed to last 35 and it's only going to last 33. As long as you can have the money in your overall fund, you can move the roofing project up to when it needs to be done, and you can use those other funds. The pooled reserves must be redone every year to take into account what has happened in the following year. You cannot use interest in the reserve fund for anything else. And you need to be able to define items in your pool. You can't just have an insurance reserve. There's no way to define that. One thing that we've seen, a lot of people had hurricane storm deductible reserves. That is not part of your reserves. So associations that want to have these other reserve items, they actually have two reserves. They can have these items in a separate reserve, and then they have their pool. But anything that does not have a determined life and time that can be scheduled out cannot be part of your reserves unless it's specifically in your docs. And I have seen that in one or two cases. But for the most part, don't include them. Do you want to add anything here, Shauna?
I was going to, I just lost the question I was looking for here. Is having a reserve line item, or having reserves, we should say, mandatory, The association is owner-based, so I'm assuming they're HOA. We're self-managed. We have only wells that are common expense. We have a contingency line, but no reserve line.
Again, it's reserves are there so that you have the money to fix an item when it becomes necessary. If you don't have reserves, there's the other way of funding it is a special assessment. So if you don't want to have those costs, go ahead and reserve. It's a whole lot easier to pay for something over 20 years than it is to have to do a special assessment and everybody come up with the money at one time.
When you repair a reserve item, how do we determine if the repair cost is paid out of the reserve fund or the operating fund?
Again, this is where you have to really look at your reserves. What are you reserving for? Are you reserving for deferred maintenance on those items, or are you reserving for replacement? And the other item is it going to extend the life? So if I do a major elevator repair, okay, and they're going to do something with the cabling, okay, that's going to extend the life of that elevator. And then you can pay that out of reserves. But if you have an annual expense, and nothing that you do annually should be paid from the reserves. That should be paid for out of operating. A lot of people try to supplement their operating budget with reserves. And every time I've seen it happen, I've seen that association within 5 years be in trouble with their reserves. So again, you have to budget enough in your operating to allow for maintenance as you're building and as your equipment ages.
Yeah, and we had a question that came in, and honestly, this probably is an answer to almost all the questions that came in prior to on reserves, how to evaluate reserves, how to go about setting your initial reserve funding, best way to determine if your reserves are correct, and then is it worth getting a reserve study done for long-term planning? So the question is yes. So if you can do it, best practice is we always recommend having a reserve study done.
Absolutely. You're not an engineer. These engineers come in and they're going to give you ideas. Just remember too that if you have a reserve study done, you can have that changed. For example, I had an association that a reserve company came in and wanted them to put all of the electrical panels in every unit for every unit on the reserve study. And they said, we replace these every couple of years as one goes out. So they did take that off, and it's noted why they did that. So I think we're going to talk about this a little later, but I just want to put it in here too. I also believe very strongly that because of the fiduciary responsibility, if you haven't been reserving or you have a study done and it's a good study and you realize that you can't, make your assessments go up 10 times, everybody is going to have a fit. So take it back to your owners. The board should never decide to underfund. That is an owner vote. And if you think that the assessments are going to be too high, then that's where your leeway is. Now, the other thing is it is a board decision whether to make that offering to your owners. Now, there are other that we're not going to go into in this meeting. There are other ways that the owners can come back and change a budget, but it is the board members can make the decision whether they are going to submit a partially funded budget. You always have to show a fully funded reserve budget.
And I think this slide, we kind of already covered most of this right? Let's see. Okay.
Right. Well, this is what I just said. It doesn't matter whether you've partially funded for the last 20 years. You must include fully funded, and there is a specific font. You have to put everything in if you're going to partially fund. And I'm sure your property management company assists with your proxies, so you should be good there. But because again, if you have $5 million in your reserves, and your reserve study wants you to have 10, then you're better off if you decide you don't want to put that money away, because there's always the balance between new owners that want everything reserved for and owners that may be moving out in a couple of years and they don't want to put the money in. And that's a balance that's always going to be there. Just remember, put it back on your owners, let them make the decision. And that's going to be the best. That's going to be the best for everybody involved. Can I take one step back? Because I missed one thing in our operating budgets that is really important.
Yeah.
When you have units that are not paying their assessments, you need to budget bad debt expense. Because this is another thing, and I had that in my notes, and I'm sorry, I meant to add it to the slide. So I just want to put that out there. If anybody has any questions, they can send them to me afterwards, and I'll be more than glad to go over it.
Okay. And a couple
Sorry
of
about that,
questions. No, that's okay. Add anything you need to. I'm sure they don't mind if you're going to add extra good content for them. So a couple of things quickly. So we just to kind of put this in a nutshell for everybody. Somebody had asked, they're not a condo, they're an HOA, and they have a ton of amenities, golf course, whole 9 yards, and the board has refused to reserve like a condo for any of those things. They prefer to special assess several thousands of dollars every few years. How can we require them to have reserves? And George, if you could just let us know for sure that you are an HOA. I'm so sorry, it does say HOA. So
have you? I'm really not, this is going to come out like I'm being smart, and I'm not trying to be. Have you considered running for the board? This is the problem. You need to change your board in order to get things. If the board is not running the property the way that you want it to be run, then you need to get involved, and you need to get a group of people involved that are willing to do this. You still have to remember something, that it is an association. I have owners that want 100% fully funded all the time, but they're only 10% of the owners. They're never going to get what they want. So, but if there's a large enough group that wants to do the reserves and wants to be better prepared, it's really time to get involved and get the community behind you. I don't know any way that you can legally force them to do it unless you become involved and change the structure at the top.
Okay. And one other question, we currently have a reserve line item for insurance deductible. Should we open a separate reserve account and have a separate reserve budget to accrue and save the deductible amount? Currently, that line item is not fully funded.
Okay, I'm sorry, can you read that again?
Yeah. If we currently have a reserve line item for insurance deductible, should we open a separate reserve account and have a separate reserve budget to accrue and save the deductible amount? Currently, that line item is not yet fully funded.
Okay, when you say a separate account, if you're talking about a separate bank account, that's an operational question. As long as it is in reserves, from an audit standpoint, it can be in the same bank account. You obviously want to be able to account for it separately. Most of my clients prefer to put it in a separate bank account so that whatever interest is earned, they keep it, and they keep it for that source. That reserve cannot be part of a pool, though. So if you have a pooled reserve account as well, the insurance deductible must be stated separately. These were very, very popular after Hurricane Wilma down here, because a lot of people didn't realize that the deductibles were very high amounts. I've seen a lot of people doing away with them now because the laws changed in 2017 that you could access reserves, whether you had component method or pooled method, if it was a federally declared disaster zone. So ease of record keeping, it's probably easier to keep it in a separate account, but not required.
Okay. I came up to the next slide. I don't know if this is something.
Okay, this is what I was talking about. You have to be able to define the life, the cost. It's a formula. Very, very important. If you're doing your own reserve studies, you better make sure that everything adds up correctly. You cannot have a zero. If you are going to do a repair this year, make sure you have a 1, because if you multiply something by 0, it doesn't come out to a number. And the DBPR has come down very hard on these. So you need to know the useful life of your assets, what is the remaining life, and what is the cost of either the deferred maintenance or the replacement. You subtract out, you take your beginning balance, how much you need to get to the ending balance, and divide it by the number of years. If you are dealing with a pooled method, and again, this is why the pooled is a little bit more difficult, is you have to go out 40 years. And honestly, you can only look at the next couple of years, because even though the schedules go out 40 years, I don't think anybody is going to tell you that 40 years from now, those estimates are going to be any good. It's just too far out in the future. Developer's funding obligation, that's really kind of in a developer. That's what I was talking about. If you're not happy with the converter reserves or how they're calculated, I would definitely, your first meeting should be with the management company that is doing those books and is working with that developer. Okay. And that's why I say, don't immediately say, oh, we have to go someplace else, because you may be losing your best source of income, of information. Mm-hmm. The other thing is they have to have an audit done. Ask for their audit and ask for those calculations. That's something that they should be able to provide you easily. And then lastly,
go ahead. I'm sorry.
No, lastly, if there's a real discrepancy and you don't feel like it's been done correctly, then you probably need to look at somebody else just to do that one part, and just to look at that with you and make sure.
Yeah, and that was a good point, Laura, with the management company. If you have a current management company with your developer, they should know. The management company, I know I've managed in my past life, developer accounts myself. We generally will bring, a proposed budget to the developer. And a lot of times they may decide just to cover some of the costs themselves to keep the costs to their owners down, which is nice at that point in time. But, once you turn over, you have to have the reality of what those things are going to cost on your own. And your management company should know, have a good understanding, good estimate of what those things really are, as opposed to, what they have then with the developer, just because the developer may have been covering some of those costs on your behalf.
And honestly, the management company has an interest in keeping you as a client. So there is really no reason that they're not going to give you that information and be very upfront. So I think everybody wants, I've seen a lot of people that just jump because they think, oh, well, we shouldn't deal with the developer. And it's really a disservice to do that. Okay.
Some of this we may have already gone through because you kind of covered it. And just so everybody knows, we can send these slides. So when my colleague Laura and I will email everybody in the next couple of days, we'll give you a link to this recording so you can share it or revisit it if you want. And then we'll send you the slideshow as well, so you can have some of this to look back on. Are you good moving on, Laura?
Yes.
Okay, perfect. Oh, and then yeah, go ahead.
I just want to say, this is the first time that I've walked through this with Castle Group, so I'm sorry I don't have my timing down as well, so please feel free to send me questions, and I'll do my best to answer them.
Yeah, and same for us, like at Castle, if you have operations questions, info@castlegroup.com, you're welcome to submit your questions, and we'd be happy to help you out with those. And this is just sample. Oh, sorry, I was going to say these are just samples, but go ahead.
Right, this is the straight line. I would like to look at the straight line. Is very simple. You can only spend it for that item. But in your pooled, I just wanted to point out a couple things on our pooled example, which I think is the next slide.
We kind of talked through a lot of this already.
Yeah, we talked about.
Yeah, we'll get to. There we go.
Okay, so this is where I really want people to really think about what they're pooled reserves for, because from an audit standpoint, if you're going to have an audit, you need to be very specific. Okay, I kind of looked through this and I tried to find some things that we would try to be upset about, or you have a line item in here, general equipment, $23,000. Okay, does that mean general exercise equipment? Does it mean that if your air conditioner breaks down, you can use it for that? It really doesn't say. But the one thing that I don't see here is carpeting. Carpeting is not furniture. I've had this argument many, many times. Carpeting is not furniture. And when you have a pooled reserve, you don't have that flexibility. So if you want to recarpet your clubhouse, that's when I was saying that you would have to pay for it out of your operating and then put it into your budget, your reserve budget for the following year. You can't just put it in and say, oh, we need to replace the carpeting, so let's put carpeting in here now for 2022, and we'll just spend it because we have money in the other reserve items. Doesn't work that way if you're having an audit done. So, and it shouldn't, and it won't work that way if you do that and it gets submitted to the DBPR. So try to be specific, because that's what your auditors and that's what the DBPR is going to look at. And as I said, the DBPR is really cracking down on they consider it a miscalculation of reserves, and they are issuing fines for that. So you want to be really careful with this. Partial funding, again, it's a matter of if you can't fully fund. I had an association that had a negative reserve balance. So it took them 10 years to get to a reasonable balance. So they had to partially fund because they were not going to go out and assess everybody a couple $1 million. So do what you have to do, but let your owners vote. Okay, this is more operational. So I think everybody knows what you have to do. I really like this last sentence: be unified in your decision as a board. Try to work out your differences, because you want to be transparent and you want to show a united front to your owners, because there's just too many splits over silly things, and it just distracts from, it's your home. It distracts from your living environment, and nobody needs it.
Yeah, absolutely. And then, kind of our summary here of really the whole process. You want to gather your information, talk to people, benchmark, form your budget committee or finance committee if you want to do that. And then, of course, hold your workshops. You can have a few of those. Sometimes you have one, as far as we go, we might have one in the very beginning, once the manager has their initial shell, and kind of filled that in based on what we know so far. And then, then you'll go back and you'll revisit, and you might have another meeting. So, prepare the proposed budget, notice the budget meeting, and then hold your budget meeting. Like we said, try to do that as timely as you can, because you want to think about when those coupons are going to go out. And these companies that, the banks, the different, entities that do these coupons are getting inundated that time of year with coupons. So you need to take all that into consideration. Make sure that, if you can have everything done by the end of October, very beginning of November, that is ideal for you.
You're the only business out there that's able to bill in advance like this. And you want to be able to take advantage of it, because you need your money coming in on the first of the year.
And then we had a question: how can you get unified as a board when the board cannot meet privately to work out differences?
Call an attorney. Have an attorney meeting. I know it sounds funny, but sometimes if you've got some real issues and you really need that, contact the attorney and have a closed meeting. You still have to notice it, but it's just like a personnel matter, but it's for the board. And I've actually seen this done, and an hour or two of your attorney's time may actually be able to pull the board together and get you on track for what you need to do. It's helpful. Okay.
Any other questions? I know we're a few minutes over, so and then again, don't feel pressured to submit questions now. Up on the screen right now, you'll see you have info@castlegroup.com. If you have any kind of operations, property management questions, you can feel free to send them there. Or if you have my email address or Laura's email address from invites and whatnot, you can email us directly. And then, of course, we have Laura's email here as well. It's her first initial last name with all of the letters. rwhsgcpa.com. But like I said, we will send emails out. Laura Bryant, my colleague here at Castle, and I will send emails out this week. You'll get that before the end of the week. That will give you a link to the this recording, as well as the contact information for Laura Gelman, and you can feel free, and I will attach the PowerPoint presentation as well, so you guys can refer back to that. But we thank you all for joining us. We appreciate it, and thank you, Laura, for being with us today.
Well, I appreciate it, and any assistance that I can be, and we look forward to doing more of these with Castle, and being able to educate people.
Absolutely. Well, everyone, have a wonderful afternoon, wonderful rest of your week. Happy budget season planning, and let us know if you need anything else. Take care. Thank